Risk assets are rebounding today on Wednesday. Stocks are up. Bitcoin is slightly up, and gold actually is holding firm but slightly down, along with silver as well. But our next guest thinks that the road to rebounding may be limited for risk assets. In fact, he is short on the S&P 500 and tech stocks, and we'll be explaining why with Alfonso Peccatiello. He is the author of The Macro Compass, and prior to being the author of The Macro Compass, he worked as a portfolio manager for a multi-billion portfolio comprised of multiple asset classes. Alfonso, welcome back to the show.
David, it's a pleasure to be back on Kitco. How are you doing?
Excellent. Thank you for joining us again. Now, last time you were on the show a couple of months ago, you had stated that it is wise to be defensive right now, and you had stayed on the sidelines and actually raised cash. That turned out to be the correct play because we have seen a very volatile stock market since we last spoke. Now, you are now doubling down on this short, and we'll be talking about why. But also, you told me offline you are anticipating a recession, 100% recession in Europe by the next quarter. And by the end of the year in the U.S., you're expecting the U.S. economy to slow down to only 2% growth. So that is a lot more negative outlook than some other economists that I've seen. The IMF, for example, has projected a slowdown, but not to the extent in which you're calling for. So let's talk about risk assets first, and then we'll go on to your macro outlook. So stocks, like I mentioned, rebounding today. Do you think this rebound is going to last for, I guess, a foreseeable future? And if not, at one point, can we see an inflection back downwards?
So, David, the answer is no. I don't think the rebound is going to last a lot. I used to start all the conversation with other investment banks when I was on the other side of the equation managing money by asking them, what's your trade? And I'm going to start this interview the same way. And I'm going to say I'm short the S&P 500 here. That's my main trade. I entered it at 4,400 and I'm expecting the S&P to drop below 4,000 at some point. And why is that? Because the Fed is telling us that they literally want financial conditions to tighten. They've been explicit about that. And if you look at the financial condition index, it's the equity market, it's real interest rates, and it's credit spreads and mortgage rates, and the dollar, of course. All of those are moving. And have you ever seen, do you remember a Federal Reserve chairman actually being happy about financial conditions tightening? I don't remember that. You have to go back in time. And why are they happy? Because they need the demand side of the equation to slow down if they want to get a grip on inflation. They want this to happen.
I'm just curious, Alfonso, what gives you the impression that Jerome Powell is happy, quote unquote?
Look at the past. If this was happening, this sort of sell-off was happening in 2019, in 2017, in 2016, you would hear straight away speakers from the Fed coming to the wire and telling you, well, guys, calm down. I mean, we're going to ease conditions. We're going to help you out. We have your back, the famous Fed put. Well, back then, the Fed was basically selling a put to the market, putting a floor under asset prices. Right now, they're actually doing the opposite. They're trying to slow down the demand side of the equation in the economy. How do you slow it down? By making your balance sheet weaker, David. By making your 401k go down a bit, make your second house in value go down a bit, so that your investment decisions are less buoyant than they were. Your demand slows down, and therefore also inflation slows down. They actually want to engineer that.
They want to engineer a slowdown. Well, yes. I mean, look, in an expansionary monetary cycle, you have inflation. They want to control that now. So I guess this is the precipice to a slowdown that may lead to a recession in the U.S. Not quite 2% growth, but not quite a recession, right?
So I expect the US still to be able to grow somehow in real GDP terms at the end of the year, but below 2%, which is way below most analyst consensus that there is out there. I expect in Europe to see a recession coming in over the next 2 quarters. We can talk about Europe separately. It has more issues than the US has. But just bear in mind that the Federal Reserve is looking at market participants pricing in, David, the same probability that over the next 5 years, the Fed will either bring down inflation to 2%, which is their target, or that inflation will exceed 5% on average. The same probability. The Federal Reserve target is to bring inflation down to 2%, and the market is telling them, you have a chance to do that. There is the same probability inflation is going to print above 5% over the next 5 years.
They've revised their target to an average of 2%. Perhaps that's their way of saying we're okay with it being 3% or 4% if somewhere down the line it becomes lower than 2%, right? At what point do you think realistically they would stop tightening? At what point in inflation do you think the Fed will say, you know what, enough's.
Yeah. So this is a question that comes to where is the neutral interest rate, right? You have been hearing these guys saying we're going to hike to neutral levels, and we're going to hike a bit above that. So the economy slows down, but it slows down in an orderly way, right? Well, that's fairy tales. It's a soft landing that hardly happens, because the neutral rate for me, David, is different than the neutral rate for somebody else. A highly levered company that is used to borrow at 1% or 2% interest rates today has to borrow at 4 or 5% interest rates. The business model most likely doesn't work if these interest rates are going up. You can see a chart I pulled up here. It's called End of an Era, where basically if you look at the pool of negatively yielding corporate bonds out there, there is nothing left. Every company has to pay up to refinance and lever up their business model. How many zombie companies that have survived over the last 5 to 10 years because, corporate borrowing rates were so low? This is coming to an end, and very soon.
Let's go back to the Fed, and then we'll talk about more of your macro thesis. The Fed last week, the Federal Reserve Jerome Powell has stated in an IMF meeting, along with Christine Lagarde and a few other central bankers from around the world, that he does anticipate a quickening of Fed tightening. Now, he did say that he did allude to a possibility of a 50 basis point hike by the next meeting. How much of this is just talk? Do you think they're actually going to do it?
Yes, they're going to do that. They're going to do 50 basis point in May. They're going to do 50 basis point in June. They're going to hike until something breaks, basically. And again, they believe neutral rates are between 2 and 2.5%, which in their head, David, it means they can easily hike all the way to 2 and 2.5% without much happening. So if the economy can actually handle 2 to 2.5%, they're actually going to go there, and the labor market is going to remain solid, yes, and the equity market is going to remain buoyant, and it's all fairy tales. So they're actually going to go for it because their models tell them that the equilibrium rate is 2 to 2.5%. Now, the pace matters as well. This is the fastest hiking cycle being ever priced in by the euro-dollar curve since 1990. I mean, the conditions for the private sector change so quickly. Mortgage rates are going up so quickly that people that now want to buy a house have to pay a mortgage installment rate, which is 30% higher than a year ago for the same priced house, and their wage hasn't gone up 30%, David. So obviously they're going to be more conservative about the housing market, for example. Same for a corporate that has to borrow at much more expensive rates. The pace of change matters for the private sector too.
You said that the Fed's narrative is fairy tale, so I'm guessing that you don't agree with the neutral rate of 2 and 2.5%, which means that by that point you think something is going to break. What's going to break by 2.5%?
Well, I'm going to say that a couple of things are breaking already. So the equity market is down about 10% year to date, which is quite a drop if you ask me. But if you look like behind the curtain, things are much worse. The Goldman Sachs Unprofitable Tech Index is down 60% year to date, not 10%. So companies they promise the certain earnings down the road, well, those promises now are much more difficult to keep. I mean, those are getting hit down very aggressively.
Is that the Fed's fault, or is that just faulty company management? Is that a macro or micro issue, basically, is my question.
It's both, but I would argue it comes more from macro. If you have a risk-free real interest rates that is extremely low and priced to be extremely low for the next 5 years, which was the case, I would like to remind people, up until 6 or 7 months ago, the euro-dollar curve was pricing the federal funds rate to be below 1% 3 years from now. So if you're an unprofitable tech and you're promising cash flows to come in 3 years, in 4 years, then you need to discount these cash flows. Your discounting rate is very low. Well, today, guess what? It's not that low anymore. 3 years down the road, the Federal Reserve is expected to keep rates above 2.5% to 3%. That becomes a pretty higher discounting rate, which results in lower equity prices.
Okay. Now, you're short the S&P 500. You told me that you're expecting a bottom around 4,000 points. So that's roughly 10% lower from current levels. It sounds pretty conservative relative to other people that are bearish on the markets. Why not 50% correction? Whereas 60%, I've heard these numbers before. I'm just curious as to how you picked your bottom here.
Well, I think in probabilistic terms, David. So that's my first target, 4,000. Yes. If it goes to 4,000, I'm going to keep my shorts running. So one of the tricks is to keep your profits run and cut your losses early, right? To be a profitable investor over the long term. So I'm going to hope that I hit the 4,000 target and we see it from there. More on a bigger perspective, the wealth effect still dominates. So basically, the way that we engineer economic growth right now is to make sure that balance sheets of the consumer become stronger and stronger because asset prices keep on going up, and your liabilities, your debt, your leverage is cheaper and cheaper. This is the model we've used for the last 40 years. And if equity prices or house prices would have to drop 40 or 50%, well, that would be a destruction of the wealth generated by 2 generations because of this wealth effect. There is no elected politicians that want that, David. There is nobody that wants that extent of pain to be generated at the end.
Okay, so let's talk about houses, right? Because you mentioned housing. You have a chart here that you show me. The size of the global real estate market. Global GDP is about 84 trillion. Debt securities is 123 trillion. Equity is 100 trillion. Commercial real estate at 32 trillion, and agricultural land 35 trillion. Residential real estate at 258 trillion.
Correct.
So it's bigger than the global GDP.
So the residential real estate market is huge. People think the equity, if you ask somebody, what's the largest market in the world? They would straight away tell you it's the equity market. Somebody will tell you it's the bond market. It's wrong. If you sum the residential real estate, the commercial real estate, and the agricultural land, the total market cap of these 3 guys together, we're looking at almost $300 trillion against the equity market cap, which is $100 trillion. The real estate market is huge. And that means that asset prices, basically house prices, sit on the asset side of the balance sheet of the consumer, and they are paramount important for the wealth effect. If house prices go down, then your appetite to spend is also going to go down as well, right? And it's the most leveraged, biggest asset class out there. People should pay attention to it.
Yeah, I have read that research. It's a prominent study among economists that your discretionary spending is dependent on your on paper wealth. So if your house goes up in value, you think you're richer even if your income stays the same. Therefore, you spend more. I don't know how many people actually regularly ask the real estate agent, hey, how much is my house worth? So I don't know how much of it this is a lagging or a leading indicator, but in any case, you're right. What indicators are you looking at right now that may suggest to you, Alfonso, that we could see a substantial slowdown in the housing market by the order of 50%, which is a number you quoted?
So basically what I'm saying is that if you look at the marginal buyer in the housing market now, David, 85% of house purchases are done with a mortgage behind. So despite all the rumors you hear about all cash buyers, if you look at the statistics, 85% of people use a mortgage to buy a house, right? So if you look at mortgage rates, they've gone up massively. 30-year mortgage rates in the US, it's above 5%. Now, if your wage hasn't changed, which unfortunately for most Americans and most people around the world, in real terms hasn't changed, but your mortgage rate has gone up from 3% to 5%, and your house prices compared to last year have gone up by 20%, all of a sudden, in order to buy the same house of a year ago, you have to pay up 30% more in your monthly mortgage payment to be able to afford that, which basically means you are not able to afford it because your salary hasn't gone up, right? So you look at mortgage applications, they're going down already. Mortgage generation going down. Wells Fargo starting to get rid of their mortgage origination stuff because there is much less demand behind. And if it's true that inventory is difficult to build because home builders are not very active, there is still a little bit of a tight supply when it comes to houses, the marginal buyer simply cannot afford the same house it could afford a year ago. It's very simple. Mortgage rates are much higher. His salary is not higher. House prices are higher. The equilibrium level for all of that must be that the house prices need to come down a bit. And I expect this year that instead of seeing the usual 10 to 20% appreciation in house prices, you're maybe going to see a flat line or a slightly negative number.
Interesting. Maybe that's the cure for inflation. Maybe it's not the Fed raising interest rates. Maybe it's, well, we'll come back to that, but maybe it's all we need is a slight correction. I'm not saying a housing crash. Nobody wants 2008 again, but maybe a slight correction in the housing market that reduces aggregate demand, reduces spending, and brings down prices back to a more, equilibrium level, whatever that may be, right?
Look, that's correct. I back that view 100%. And that's what the Fed is telling us. It doesn't matter if I think that's the right path or you think that's the right path. The policymaker is telling us he wants to slow aggregate demand by slowing down the wealth effect and tightening financial conditions.
Okay.
Well, that's what you should go for, right? You shouldn't fight the elephant in the room.
So it's not so much the 2.5% interest rates in itself that's going to combat inflation. It's everything else, the spillover effects of the tightening. Because I'm just wondering, if I were the Fed, obviously they have some smart people working in the Federal Reserve, they probably know this already, and they're thinking to themselves, why bother raising interest rates at all if the economy is naturally going to slow down anyway? Because think about it, if inflation continues to run high, at some point, economics teaches us that people will stop spending as much as they used to. If prices keep going up, their demand goes down, prices fall back to equilibrium. Why do we need the Fed to intervene at all?
Well, the good thing about that is that the Fed doesn't think the economy is going to slow down that much. In the latest summary of economic projections at the last Federal Reserve meeting, they showed us the following, David. I found that impressive. They showed us they want to hike rates to 2.8%. This was their last projection. And they're going to keep rates at 2.8% for 2 full years. And do you know what the unemployment rate projected was over 2023 and 2024? It was 3.5%, 3.6% in their projections. Basically, they're telling you, we're going to hike rates, we're going to hike them pretty fast to 2.8%, and the economy isn't going to care. The labor market is going to remain very hot. GDP growth is going to remain very buoyant. So effectively, they think the private sector can take a lot of hit with no problem. I disagree. And you know why? There is 35 trillion of private debt in America. And this is not federal government debt. The government, as a printer, they literally can print away their debt if they want to, because they're the currency issuer, not the currency user. Well, the private sector, can you print away your mortgage, David? I wish I could, but I can't. If I have 35 trillion in private debt, I need cash flows. I need my wage to go up. I need economic activity. And so the private sector is going to suffer.
Okay, so last note on the real estate market. Yeah, you're right. The mortgage rates have been ticking up. In fact, the 30-year mortgage rate in the U.S. is now at the highest level since 12 years ago. So not even pre-pandemic, but 12 years ago. So this is becoming, I wouldn't say unaffordable for some people, but it's getting there. So is that going to have an immediate effect, or do you think people have locked in fixed rates, and so maybe that doesn't matter so much?
So I want to shed light on this point, and thanks for the question. It is true that a lot of people have locked in fixed interest rates for the next 10 or 20 or 30 years.
Yeah.
Great. But you're looking at prices, and prices need equilibrium clearing levels. They need a buyer, they need a seller. Now, if the economy is slowing down and you're losing your job, David, then you need to maybe refinance your mortgage, or you need to sell your house, right? And you're looking for a new buyer. That new buyer, the new marginal buyer, as you just said, he can't afford the same price that you have today, because his mortgage installment rate has gone up by 30% on a monthly basis compared to a year ago. And his salary hasn't gone up by 30%. So his clearing level to be able to afford your house as the new marginal buyer is lower than it is today, which means the price mechanism needs to reprice a bit down. And that's exactly what the Fed wants, I think.
Realistically, how far can the real estate market correct?
So depending on the supply that comes to the market as well, and if mortgage rates continue to go up at this pace, I would expect that this year you have a correction in the single digits in America, so something down between 5 and 8%. And then it depends on how does it adjust from that point. So do mortgage rates continue to go up, or do they move down a bit? Does the Fed maybe get scared and move in? I don't know that yet.
Alfonso, they say real estate can never fall. Remember, ever heard that before?
Yes, I've heard that before. But if you think about that, David, I mean, the real estate prices keep on going up. I live in the Netherlands, and in the Netherlands, in Europe, we have seen real estate prices going up 15% a year for 5 years in a row.
Yes.
I mean, of course, everybody's rich, right? Because its house price is it's basically doubled over the last 5 years. That's also something unhealthy and unsustainable, if you ask me.
Yeah, well, I guess the Dutch people would disagree with you. I think they're not very tired of being rich, but yeah. All right, let's move on. So I want to just touch on Europe very quickly. You mentioned that Europe, you're seeing a 100% chance of recession in Europe by the end of the quarter. I'm just wondering why you think economic conditions in Europe are worse than in the U.S., because you're not calling for a 100% chance of recession in the U.S. by next quarter. You're just saying a slowdown.
Now, think of the following.
Yes.
Spanish producer price index went up 45%.
Oh, I saw that. Yeah. That's scary.
German producer price index 35% up year on year. So basically, companies are facing huge production cost increase, which they have a hard time passing to the private sector. If they do pass it to the private sector, then it's complete mayhem. In the private sector, we just can't afford such an increase in prices because wages are not moving up in Europe. real wages in Europe have gone down by the tune of 3% year on year. That's even worse than in America. So the private sector is already suffering from a loss in purchasing power. The producers are facing higher and higher costs because don't forget, Europe is a net energy importer. So contrary to the US, which on a commodity aggregate level, it's much more balanced as a country between import and exports. Yes. Europe is a big net commodity importer. And because, of especially energy prices and the reliance on Russia, that has, of course, applies further toll on a private sector that is already battered by basically real wages being very negative. And it's a situation which is compounded by the energy situation and also the fact that the fiscal reaction that Europe had to the pandemic is much smaller than the US fiscal reaction, which was gigantic.
Okay. That's a fair point. Now, the IMF, just circling back to this, the IMF had stated that global growth is set to decline. They're not nearly as bearish as you are on growth. I'm just going to state some of the numbers here. They had said that global growth would have been 6.1% in 2021 and 3.6% in 2022 and 2023. This is down 0.8% and 0.2% from their January forecast. So, their 2022 forecast is still 0.8% lower than before. But what's interesting to me, Alfonso, is that their 2023 forecast is only 0.2% lower than before, which means it's relatively the same. I think what they're saying is because Ukraine is happening, with the war in Ukraine is happening, 2022 will have a slowdown. But they're indirectly implying that the war in Ukraine is not going to have a long-term impact on growth because 2023 is going to be flat. Or maybe they're saying the war in Ukraine is going to end soon and not have any, spillover effects into the next year. Do you agree with any of this analysis?
Have you ever seen a policymaker projecting a recession, David? I haven't in my life. And obviously because they like status quo, they like controllable outcomes, they don't like tail risks. And it's very difficult for them to politically justify projecting a recession down the road, right? So they're never going to do that. Now, I think most of the 2023 growth and going forward depends on the policy reaction. And never, like now, we have seen central banks corner as they are, because in the past, if the demand was slowing down and asset prices were slowing down too much, they could simply intervene and put a floor under all this process. How can they justify now intervening if inflation is still printing at 7% in the US and at above 5% in Europe? It's much more difficult for them to justify such an intervention, right?
Yes. Yeah, fair enough. So, right. Well, let's see what happens. What do you think is going to happen to the war in Ukraine? Let's just go over that for a few minutes, because that obviously has a big impact on the economy. Much of the European slowdown, I presume, has come from the war in Ukraine. So do you think it will last for longer than the end of the year?
Well, if you see the latest action by Russia, they today stopped gas exports towards Poland. And that is pretty tricky because effectively it blackmails Europe. It basically says either you pay myself in ruble if you want my natural gas, or I'm not going to deliver any natural gas. And despite whatever Europe says, at the moment for Europe is extremely difficult to source natural gas and energy away from Russia. And so they're facing a pretty much of a stalemate where they either kneel to the blackmail and they pay in Russian ruble, which will strengthen the Russia economy, which they don't want during a war, obviously, or they're going to have a serious problem sourcing their energy. So if I see this Russian chess move, let's say here, I don't think the situation is getting any better any soon. But again, I'm not a war or a geopolitical expert. I just wish for this to end as soon as possible to get peace back.
Certainly military escalations as well. The U.S. just announced an additional $800 million of military aid. This comes as a Russian flagship frigate or cruiser has been destroyed by Ukrainian forces. Well, the Ukrainians claim responsibility. The Russians say it was an accident on board the ship. So the Navy was under attack, more military aid from the U.S., more military escalation. So,
And David, look at this global supply chain pressure index that the New York Fed developed. I think it's a very interesting index. It takes 27 indicators for how the global supply chain is, flowing effectively. And it looks at the standard deviations from an average value. So they take a 25-year moving average of this index, and then they look at how much is it deviating from this average, right? They look at deviations from the average. And look at this chart. It's now almost 5 standard deviations from the average value. which means the global supply chain is getting pressured as never it did over the last 25 years. And it's not only the Ukraine story, it's also the zero COVID policy from China. Right. If you look at the number of ships waiting outside the Shanghai port, either to get loaded or discharged, it's now around 800 ships compared to an average around this time of 250 at any point in time of the last 5 years. So we're talking about basically a bunch of raw materials and commodities and semiconductors pieces and other pieces of the supply chain being stuck either in Ukraine or in Russia or in China. And we're starting to have serious problems with the production chain in Europe and in America as well because of that.
Well, let's just take a look at this chart that you brought in. So, a very interesting chart. What it shows is standard deviations from the average value. The positive value means more pressure. Negative value means less pressure. So, we saw a spike in the beginning of COVID in April 2020. It came back down dramatically, and then it started trickling up. Now, this was this was before Ukraine happened. This was before the latest outbreak of COVID in China. So, what happened? Why did it start ticking up?
Well, I think most of it has to do with China being applying a zero COVID policy, which basically means getting in and out of China is extremely complicated, not only for people, but also for ships, right? Trying to load up and discharge materials from China that are then used in the global supply chain. And now the latest leg up you see in this chart is then driven by the Russia-Ukraine story, because don't forget, it's not only about oil. It's also about corn, wheat. It's also about neon. Ukraine exports 85% of global neon, which is a gas used in producing semiconductors chips, which are then used to basically in everything we have. In the computer we're using to have a chat, in medical devices, in any other instrument we use, there are these semiconductors chips. And without neon, it's much more difficult to produce them. So do not underestimate the supply chain pressures, which unfortunately don't seem to be easing anytime soon.
Okay. Well, before we move on to specific asset classes like gold and Bitcoin, I want to get your thoughts there. Do you have any macro good news for us?
well, the macro good news, it's very hard to find at this stage. I think things have to get worse before they get better, David. So central banks want aggregate demand to slow down. That's the big picture, because they cannot control this index. I just showed it there. Central banks can't do anything to make ships flow more easily towards China or back from China. They can't make the war stop. So the supply side of the equation, they can't control. They can try to control and influence the demand side of the equation by a second round effects, like mortgage rates higher equals house prices down, for example, or equity prices down. And they will be doing that because that's the only lever they can apply to ease inflationary pressures. And things have to get a bit worse, unfortunately, before they get better.
Okay. All right. I got to ask you, because it's my job. How much worse?
Fair enough. So I would say that when we start seeing the first more evident signs that growth is slowing down, and or equity markets start to drop more aggressively, I think below 4,000, it will ring some bells at the Federal Reserve, especially if growth is slowing down, David. They will imply that also inflation is going to slow down as a result. And if that happens, then they feel more comfortable with, slowing down their hawkish stance.
And I just want to figure out what's going to happen to corporate income statements as well as corporate lending, because this is another interesting chart that you brought up. It says end of an era born of central bank largesse, negative yielding credit disappears. So this chart shows in trillions of dollars how much corporate debt outstanding amount of negative yielding corporate debt there is globally. Right now it's close to zero. Yeah. Whereas not too long ago, it was $1.6 trillion of corporate debt that had negative yielding coupons or interest. What does this imply?
Well, it implies that things are getting very tight for the private sector. I said before that the private sector debt in the US is $35 trillion. So now imagine you're a company, David, that levered up, and you were in 2019, one of the companies that had the luxury to borrow at negative yields. I mean, again, negative corporate bond yields. So basically you were paid to borrow at the end of the day, right? And now this bond is about to expire. So you need to refinance. If you want to keep the same leverage, you need to refinance, right? And then you go and check the bond market, and instead of paying negative yields, you're going to be paying 2 or 3 or 4%.
That's right.
And maybe you're going to be like, okay, let me double check if I can service this debt at 3 or 4%, if my business model is still viable with all this leverage that I've accumulated. Well, in most cases, I guess, especially if you're a zombie company or a non-profitable company and your cash flows are pretty weak, you can't afford to refinance at 4%. And you know what you're going to be doing? You're going to be deleveraging. You're not going to be refinancing. You're not going to do investment plans. You're not going to hire because your leverage has become much more expensive all of a sudden. And that's how you slow down aggregate demand in the equation. And if this process goes too much beyond what the economy can take, then you slowly sleepwalk into a recession.